Hello guys, welcome back to my channel. Don't forget to like, share, comment, and subscribe. US stocks are looking expensive again to some investors as the Federal Reserve's hawkish message lifts bond yields and push market participants to resist equity valuations. The S&P 500 as forward price to earnings ratio, a common metric for valuing stocks, has crept back up to around 17 times earnings after a sharp rebound in equities from their mid-June low. The valuation for far below the nearly 22 times forward P or E stocks commented at the start of the year may have seemed reasonable earlier this month when markets were rallying on hopes that the Fed would end its monetary tightening sooner than previously anticipated. Fed Chairman Jerome Powell all but crushed those hopes with an unambiguously hawkish message at last week's Jackson Hole conference, and some investors now believe stock valuation may have to fall further to reflect the risk of rising bond yields and a looming recession. Comparatively modest valuation were on one of the biggest positive the market possessed at the end of the second quarter when stocks stood near their lowest levels in one or 2 years after a 6-month shellacking and forward PA hovered at just about 15 times, said Matthew Miskin, Chief Investment Strategist at John Hancock Investment Management. After rallying 10 years, 10% from their mid-June low, stocks are not pricing in as much risk, and that is something that the market is going to have to grapple with as we get through the back half of 2022, Miskin said. Among the dangers to equities is a rise in treasury yields that has accelerated as investors come around to the idea that the Fed is determined to raise interest rates higher than markets had previously expected, climbing treasury yields, which moved inversely to bond prices, tend to price equities in part because U.S. government bonds offer a risk-free alternative to stocks. Raising yields weigh particularly on valuation of companies such as those in the technology sector that have high expected future earnings and are significant parts of index like the S&P 500. The mid-June low for the S&P 500 comes as the yield on the 10-year U.S. Treasury note rose to about during the summer. The 10-year yield has rebounded to 3.1%. As a result, the equity risk premium, the extra return investors expect to receive for holding stocks over risk for the free government bonds, has recently fallen the rock its lowest point since 2009, according to the Wells Fargo Investment Institute. Analysts they recommend that investors skew their portfolios away from equities and toward fixed income and commodities. The stock market is incredibly expensive when compared to the now higher 10-year yield, said Summer Samana, senior global market strategist at Wells Fargo Investment Institute. The S&P 500 has fallen 5% since Powell's speech on Friday as investors adjust their expectation for how high the Fed will lift rates. The S&P 500 was down 0.9% on Tuesday afternoon. The market had to quickly price in a soft landing and had little room for error left, wrote Kate Lerner, Chief Investment Officer at Trice Advisory Service. However, even after the pullback, it's too soon to say the risk-reward is compelling. Still, current valuations are at a premium level given uncertainty in the earnings outlook and continued monetary tightening, Lerner said in a note on Monday. Based on current forward earning projection, Lerner estimate a decline in the S&P 500's PE to 15 times would put in the index at just above 3,600 around its June lows and equivalent to a drop of more than 1,000 from Monday's closing level. Okay, that's all from me. Thank you for watching. Don't forget to like, Share, comment, and subscribe. See you.